Well, I'm sure some people might hop in during the presentation, which is totally fine. This will be recorded. As Lisa, you've hopped on some of these before, but um, today, we have Christina Clark with our product team that's going to be presenting for our agents and explaining a little bit more about our 1099 and bank statement programs. Oftentimes, the biggest challenge we're seeing with borrowers right now, especially self-employed borrowers, is that they make a good amount of money, but their tax returns don't necessarily tell us the full picture, which can put them at a disadvantage when it comes to qualifying. So programs like the bank statement loan, the 1099 loan, rather than relying solely on tax returns, it allows us to look at the income in a way that better reflects how much money they actually earn. So oftentimes this is going to be great for your real estate agents, business owners, contractors, gig economy workers. So these are some strategies and some programs that you can use to help people qualify that ordinarily might not. So without further ado, I will let Christina go ahead and get started. This will be recorded. You'll get a copy of the recording for those that aren't in attendance live today. And we're excited to hear what you have to share, Christina.
Well, good afternoon, everybody, and thank you for inviting me in. My name is Christina Clark, and I'm with the credit policy team at Fairway. Been here 11 years, and we're going to go over the fun world of 1099 and bank statement products, which are all non-QM products for the Fannie Mae and Freddie Mac definitions. So non-QM will always have a little bit higher pricing, a little bit more leniency, and will fit those needs of your self-employed borrowers who aren't paid typically. And as Richard said, typically a lot of self-employed borrowers take advantage of the tax holes, the loops, so they don't have to pay as much taxes. So can everybody see my screen here? We're going to go to the agenda, and we're going to go over the 1099, the non-QM, and any final tips and takeaways. And then also, if we have some time left, if you have any questions, I'll be happy to try to answer those for you. So let's start in with the 1099 product. So typically your 1099 borrowers are going to be your contractors, your freelancers, somebody who's a gig employee, seeing a lot of hairdressers. They may work for a salon, but they're paid 1099 because they're an independent contractor with that salon. You'll have entertainers, somebody who's a singer on the weekend, things like that. Anybody who's going to fall in that realm with their 1099. Most of the investors do require at least a minimum of 2 years of the borrower receiving 1099s. Well, you also have some 1099 contractors who may be an IT contractor, right? So they may work for Verizon for 10 months, 1099, and then they go over to AT&T for 8 months. And then so if you combine those together and they have a full 2 years, then they would qualify under that 1099. So with that 1099, this is a good way to be able to document that borrower obtaining that income and being able to qualify because you have this steady stream of those borrowers obtaining that. So typically they're for your independent contractors and 100% commission. To your self-employment is required. And here's where the kicker is. You have to be able to obtain the year-to-date earnings. So if they're working for some place that they're getting in that 1099, they have to be able to provide them some type of year-to-date earnings to where we can, so the underwriter can match it up to what's on that 1099 to make sure that it's in line to what we're going to be having for the end of the year and what they've received to what they learned in the past. Most investors will permit 1 to 2 years. So you can qualify with just 1 year. So let's say the borrower in 2022 because of COVID had a bad year. So you only want to qualify. Well, let's go back. Only want to qualify them in 2024 because in 2023 they had a bad year. They will permit only qualifying with 1 year, where you have to be able to document at least 2 years proof. So now remember, if you're going to qualify with only 1 year, might be a little bit more of a pricing hit, but their investors do permit 1 year 1099s, 2 year 1099s, but they have to be self-employed for a minimum of 2 years. There also is an expense factor that varies that they'll take off of your 1099 based upon if it's sole proprietorship or if they're in business with other people. So a couple of the investors will permit them to be 50-50. And the expense factor will vary based on the employees within that business. It will go anywhere from 10% to 15% they'll take off of the 1099 income. So if the 1099 showed Richard as a 1099 borrower, makes $100,000 a year, he's the only person for that 1099, that business, then it would be 10% if that investor allows it. So we would only qualify him at 90,000. Excuse me. So investors, it'll be 15%. So it would be less 15,000. Any questions on that? Sorry about that. Got a little tickle in my throat. Now, with these investors, they will permit up to 90%, some of the investors, and some of them go as low as a credit score of 600. With a credit score as low as 600, obviously you're not going to be at that 90% LTV, but we do have some that will permit that credit score as low as 600 and 12 to 24 month options. Also, like I said before, the expense factor will vary. So you have a lot of wiggle room here. And also, MI is not required. If they go over that 80%, if you go up to that 90%, the investors don't require them to have mortgage insurance. So this would be a great opportunity if you have that borrower who doesn't want to pay that mortgage insurance. They wouldn't have to do that because it's a non-QM product. So now on to our favorite, our bank statement product. This one right now is a very hot one and it's being utilized all the time. And these can go for, again, your self-employed borrowers, whether you're a real estate agent, you can also be an investor with somebody, 50% business. You can use personal and business tax returns, or you can some of them will even permit you to commingle and use personal and business. So if you have your, let's say Richard owns a donut shop. He decides to have the money go into his personal bank statement. You can use those deposits from the Square, the Venmo, things like that. Some of the investors will allow those to count as the deposits if you can show that trend. So it can't be just one big Venmo payment for $500. If they're consecutively getting those Venmo or their Square payments, then the underwriter can see those that's a trend that the borrowers received that over the 12 months or the 24 months, depending on which option they're going with. Because we all know when we go shopping a lot of places, they prefer the Venmo now, right? Because they don't have to pay the fee. Hairdressers, a lot of times hairdressers will do that. You know, pay me Venmo, pay me Zelle. You can use those on the bank statements. They'll even accept ATM deposits. Some places will go and deposit a bunch of money into the ATM machine. If you can show the trend of the deposits, that it's not an outliner and it's the consecutive thing that every week Richard goes down and makes a deposit at Chase in between $1,000 to $2,000 in ATM deposits, then that's that trend that they're looking for. So there's the flexibility on the income verification, and you can accommodate a lot of broader range of people's financial credit profiles because we're looking at what's going in, what's going out, and is it consecutive or is it declining? Hopefully it's increasing and not declining. The cons of the bank statement program, because it is a non-QM product, it's going to have higher interest rate and higher fees, may require a larger down payment depending on the investor. Again, as I stated before, 12 to 24 months options. So the borrower must be self-employed for a minimum of 2 years. However, they do have the option of providing 12 months bank statements or 24 months bank statements. Again, your pricing is going to vary. It's going to be higher if you take the 24 months instead of the 12 months. And they also permit it on primary, second, and investment homes. So this product can be used for a range of all your occupancies. So that's a big pickup too. So it's not just for a primary or second home. They can also do an investment property with this. Maximum LTV is up to 85%. Again, no MI would be required. So again, another pickup. Also have the lowest credit score an investor will go down to is 600. So if your borrower's got some little minute credit dings on there and the credit score is a little lower, they could still possibly qualify with this, with that. And just because it's non-QM doesn't mean that it has to be a higher loan amount. A lot of these investors will allow a loan amount as low as $100,000. You just have to be careful with your QM points and fees to make sure you meet that threshold, right? Because you don't want it to go into the non-QM high points and fees cost. So there might be a little bit of wiggle that we have to do based upon that loan amount, but you can go as low as 100,000. So that's a great pickup for you. Got a borrower who wants to buy a second home for $200,000, but doesn't have the standard tax returns that show the income level that they're receiving because they're writing everything off. So this would be a great option for them. If your DTI based upon what the income is going to be is over 43%, they do require residual income. So do note that. The borrower cannot have somebody on the loan without an exception. With somebody doing the bank statement product and also doing a 1099 product, or they can't have a borrower doing the bank statement product and also wanting to do a borrower who is needing to use rental income from another property to qualify. Because in order to do that, typically we have to obtain the tax returns, correct? So the whole point is to avoid the tax returns. We can't unsee it for this lane and not that lane. There are some investors that will permit other documentation for the rental income, but try to steer away from that. But there are some investors that will that will let you have copies of lease, a bank statement showing those deposits going in, checks, whatever. But they're very few and far between. It is sometimes a little bit harder to document, but it can possibly be done. Underwriting recommends to, when you're trying to set up your borrower to figure out what that income is going to be, is if you're going to take 12 months qualifying instead of 24 months, to take all the deposits over the 12 months bank statements that you have, and you have to obtain all pages to all bank statements. So the bank statement says 1 of 4 pages, we have to have all 4 pages. To take the deposits on all 12 of those, add them up, divide it by 12. That's the most conservative income approach to use. And then they'll get into it and see and divide out and take out that expense factor. But go ahead and use that as your baseline before it's submitted to underwriting. But that's the recommendation from underwriting for you to utilize on your applications. So if you're using 24 months, take the 24 months, divide by 24, 12 months, divide by 12. And also, when you get those bank statements, you need to look at if the borrowers have any NSFs, non-sufficient funds. This one seems to get tripped up all the time, is a borrower may have a line of credit, and so it goes over. And they consider most investors consider that an NSF because they didn't have the funds. They're taking it from a line of credit. So most investors only permit 3 in a 12-month cycle. So you need to make sure that you do look out for those, because some of them is a hard stop. Some may permit with a letter of explanation, but you need to make sure that you're looking for those NSFs on those bank statements when you're looking at the borrower's profile when you're doing that bank statement loan. Some will permit the commingled bank statement, so they will let you use both personal and business in the commingling of those deposits. And again, you would want to add it all together and then divide it by the 12 or the 24 months. And also you'll need to provide proof of the 2 years self-employment, whether it be a letter from the tax return, or not tax return, tax preparer, some type of thing you'll have to provide proof that the borrower has been self-employed for up to 2 years or more in the same field.
Christina.
Yes, ma'am.
Thank you for all this. I do have a few follow-up questions.
Yes, ma'am.
So the bank statement and 1099 programs, you know, a lot of the realtors like that we have the Fairway Advantage program available. Are these
Yes.
programs that can be used with the Fairway Advantage, which means our underwriter underwrites the loan based on a to be determined property to make sure we can vet the income properly up front, because the realtors obviously aren't the ones looking at the bank statements and calculating,
Right.
we are. So would that fit into our Fairway Advantage? Because I know we'll have some questions on that.
Yes. So in my speaking with the jumbo underwriting team, the scenario team, they actually prefer that you do that. Is that if you're gonna utilize a borrower with a bank statement program, right? Obtain all that documentation up front, send it over to them, and let them make sure that your borrower does qualify. So yes, it can be done on a TBD. Absolutely 100%. And that's the most preferred method to go.
Okay, I always like to let the real estate agents know this, because as they are meeting with the clients and driving them around in their cars, it's important for them to encourage the customers, especially self-employed customers, to vet out all their options, see if it's going to be the tax return, the traditional way of qualifying, or one of these other programs that will allow more buyers to qualify, and also in a lot of cases for a higher amount in terms of what they could qualify for. Assuming that they can meet the requirements of showing the money going in and out of their bank statements. And then also the 1099, the hits on the, you said the 10 or 15% hit for the expense ratio, whereas I've seen a lot of tax returns over the years where self-employed buyers, like you said, are taking full advantage of the tax laws and writing off 50% or more of their income. So that can really hurt somebody in qualifying for an amount, a price point that they want to. We know that they earn the money, but again, they can't have it both ways. So that's
Right.
where these programs would really come in and benefit. I'll say one other thing. You mentioned the NSF, which is the non-sufficient funds. That's, you know, when somebody in your bank statement, they overdraw it and then they are charged money from the bank because they have non-sufficient funds in the account. You're saying most of the time it's going to be maxed at 3. We have a story. We were working with a client, Richard and I, earlier this year. He had a painting business. He made good money, but his tax returns, he wrote off so much. So we wanted to flip him to the bank statement program. He'd be a perfect candidate, and he made way more money under that scenario as far as the qualifying income that we could use. But he had more than 3 NSFs, and then it was a hard stop. So we were able to, as part of the pre-approval process, as we work through these different options, identify that, let him know that, hey, nothing can be done right now, you know, kind of get that in order, make sure we can get within 12 months, less than 3 months, non-sufficient funds, and come back and we can help you with buying a home. So we're hoping this October will be kind of his time where he can come in and try and buy a home. But that is a real life example of how that buyer would have originally been turned down just using tax returns, but we were able to qualify him for a lot more, but he got, you know, stumped on the NSF, at least for the short term. Yeah.
Right. And like I said, I mean, we see it happen, right? I mean, so there's all kinds of different things that you can put them into. And it is true. I mean, we see it all the time. Borrowers who have that 1099 income or sole proprietor, they're writing off everything, which they should. Unfortunately, for qualifying purposes, if they go the traditional tax returns, they can only qualify for $200,000 home instead of a $500,000 home. So that does make a big difference for those potential borrowers. So these are great products, and Fairway's delegated for a lot of these, for all of these products. Fairway's delegated, so we don't even have to send this to anybody. We underwrite these in-house. So therefore, any decisions that need to be made, unless we have to get an exception, right? One of those one-off things, that's something that we can do here at Fairway. So we can do that timeline for you. So that's a great benefit here at Fairway, as us being delegated.
So what you're saying is that the buyers can close in a, 21 day versus a 30 to 45 day timeline because we don't lose control of the loan, having to send it out to another, another underwriter with a different company to underwrite it to
Absolutely.
their guidelines. Our underwriters have already been vetted and are allowed to make those decisions.
Absolutely. And that makes a huge difference when when you are delegated, but Fairway is delegated to underwrite these loans, is we are not on now that investor's timeline. So we're
Correct.
on our timeline. So we can get it done and get it out of there and get your bar closed and out the door into their new home.
Looks like Lisa has a question. How much higher is the interest rate for these products? And Christina, I don't know if you want to answer that, or me and Leslie can.
I'll
address it.
let you, I don't know the interest rate, so I can't, I just
Sure.
know that there's a pricing it, so I can't answer that.
So Lisa, the answer is it depends. Depends on the credit score, the down payment and such. But I mean, I would say, on average, you're probably looking at least a quarter to 0.5% higher in rate than you would be seeing if it was not a non-QM product. My best guess up front without having a specific scenario.
And some of that will be offset if we're just looking at payment, because again, we're not going to have to be considering PMI in these. So yes, a lot of times when we look at this with a customer, we're going to show them, yes, that interest rate is higher than what you're seeing average interest rates on the market be. However, let's compare the payments, and they're usually not going to be that far off. So those are, you're going to pay for that non-qualified mortgage, additional risk is what that is. And obviously
And
there's going to
also,
be a trade-off for that.
and also, as you just said, if you're over the 80%, they don't have to pay that PMI.
Correct.
So
Yeah, that can make a
that's it.
difference.
Mhm. It's a huge
Sure.
difference.
Okay. Any other questions? Riley, good to have you on the call. If you have any questions, just unmute yourself. We're close to finishing up here. So any other points, Richard or Christina?
No, just like I said on that bank statement one, just make sure to get all the pages of that bank statement, add up the deposits to give you that idea, or send it over to Richard or Leslie and get them over on that TBD so they can get it up front and done, so the borrower has the accurate figure of what they're looking at.
Richard, do you have anything to add?
No, to that point, Christina, that's definitely helpful. Like in the situation, like Leslie had mentioned, if we had not gone through and vetted that up front and had our underwriters take a look at it, that might have been something that could have gotten missed. The bank statements, especially for business owners, there could be hundreds of transactions on there where something we might interpret it one way, the underwriter might interpret it another. So it's absolutely worth it. Before you get people in your car, driving them around, have us go ahead and take a look at everything, have our underwriters take a look at it, and we can give you that assurance up front that there's going to be no issues down the road.
Yep.
Okay, that sounds good. One last point before we let everybody go. I wanted to talk just very briefly about a new program that Fairway just brought into the market last week, and that is a half-zero temporary buy-down product. And basically what that means to the buyers is that Fairway will be subsidizing the buyer's payment for the first year by 0.5%. So if the interest rate is 6.75 normally, we're going to give the buyer a 6.25% interest rate at no cost to the buyer. It's lender paid for the first year. And then years 2 through 30 would be at that regular note rate. So if you have anybody out there sitting on the fence, kind of grumbling about rates or just a little bit off from qualifying, this might be a good opportunity for us to take a look at them. But we're excited about it, and we think that it's going to excite some buyers and some real estate agents out there. So let us know if you have any questions about it. And then yes, you're welcome. Okay, well, I think that's it. Christina, thank you so much for helping today with presenting the information, and we will certainly be happy to answer any questions after the fact if anybody has any questions, but have a great rest of your day and rest of your week. Thank you.
Thank you. Thank you.